These days, there are a lot of places for you to park and grow your cash. But the story is a lot more than just the advertised rates. So let's deep dive today into what you really should be looking at when you are deciding where to park and grow your cash. Let's start with fixed deposits. We call it FD, shown on the bottom left of this diagram. Fixed deposits are akin to money in the bank, but the only difference is that you have committed to locking up your money for a certain period of time, and in return, your bank guarantees you a certain yield or income that you will receive from that deposits. Fixed deposits are also under the bank deposits guarantee up to a certain amount, and that really reduces its risk. In general, even though there is always a chance that there can be a bank failures, in modern day banking, bank runs is very rare to see. So fixed deposits generally considered ultra low risk. The risk is not zero, but it's very low. Now, once you move up to the next spectrum, we have the money market funds. And these are funds, they are committed to investing in very short dated papers, bills, income generating assets. They would even invest a substantial amount of its portfolio into fixed Ds that's owned by banks. It could also include assets such as accounts receivable from corporates. Money market funds in general have an average maturity of 3 months, with a legal limit of no assets being more than 6 months in maturity. So it is very high quality as well. The names in there, and they tend to be rated at investment grade or above, and they tend to be very liquidly traded in the market. Now, once you move to the next product, we have enhanced liquidity funds. They are similarly managed to the money market funds. The only difference is in the maturity of the underlying assets. And for the case for ELF, the assets are on average around 0.8 years, so it's longer than the money market funds, but it's still considered very short term. In addition, the credit quality of the names behind an ELF is also very high, and they generally are investment grade or above. But because ELF comes with it a longer duration or maturity of the underlying assets, and hence more cash flows are exposed to interest rate movements day to day, it is somewhat incurs a bit more risk than the money market funds. In return for that more risk, the higher risk level, an investor would in return get a higher yield in general from the ELF than the MMF or the fixed D. Now moving on to ultra short-term bond funds. And these funds are also very high quality in nature. And when we say ultra short-term bond funds, it's still very short-term in maturity, but they are higher than MMF and ELF. In general, a bond, a corporate bonds or any assets of that sort, they tend to have a maturity that can range from 3 years to 5 years or even longer. And the ultra short-term bond funds, as the name has suggested, they tend to hold bonds with much shorter maturity of around 1 to 2 years. A special feature of ultra short-term bond funds is that they're all amortized valuation. What it means is that because they are designed to buy and hold these bonds to maturity, and because they are also very short-dated in nature, future cash flows and earnings from those holdings are also relatively more predictable, and hence the funds tends to amortize the earnings that they expect to earn over the life of the assets they have, and the principal that would get back towards the end of the life of the assets, right? So they would sort of amortize and interpolate from those expectations and mark the fund's value accordingly. So ultra short-term bond funds are amortized bond funds that does not subject you to a floating NAV day to day, and hence can be perceived as having lower volatilities. So the fixed D, money market funds, enhanced liquidity funds, and the ultra short-term bond funds, they are collectively perceived as being in the category of cash management funds. Cash management funds tend to have very strict criteria about credit quality ratings, maturity of the underlying assets, and they have to be very low risk. Now, once you move beyond the cash management realm, you start seeing a variety of bond funds, and they could range from short-term bond funds that hold bonds, but they do not necessarily would hold to maturity, but generally the assets they hold are shorter term in nature. These funds tends to be more tracking in nature, and they do benchmark themselves against some of the underlying indices. However, there's all a variety of bond funds out there, and in the category of actively managed bond funds, you not only take risks with respect to the underlying assets the fund owns, the investors will also have to take the risk of the fund manager's performance. There will be more turnover of the assets within the portfolio of an actively managed bond funds. A fund manager could also buy or sell securities, and hence investors are also exposed to market timing and trading risks of actively managed bond funds. But in return, the higher risk in general comes with higher expected return, but these bond funds are no longer considered safe and generally could be moderate risk level. And lastly, we have another category of income generating assets called Reits, Real Estate Investment Trust. There's a lot of types of REITs out there, but in general, they are funds that's launched to own the properties of different types. It could be data centers, warehouse, logistics focused assets, commercial REITs that include shopping malls, or hospitality REITs that focuses on hotels and tourism related assets. So there's a variety of REITs itself. In general, they are considered higher volatility than the funds that we have seen before. In the case of a shopping mall, we do have a risk being exposed to the general economy and the income level of consumers, because after all, traffic at malls is correlated with how well consumers are doing. Now, to recap, looking at the cash management funds arena, we have fixed D, MMF, ELF, and ultra short-term bond funds. Generally, the fixed D is the lowest risk because it does not subject to mark-to-market fluctuations at all. However, it's less liquid than some of the other funds in the sense that you're committing to depositing your money for a fixed period of time with the banks before you get your earnings. Now, the money market funds and ELFs and the short-term bond funds, they tend to be lower risk and they're highly liquid. And they generally belong to the category of investment grade quality. Now, further up the risk spectrum, we have bond funds of a wide variety, ranging from short-term to actively managed, and they can be moderate risk level in nature. And also liquidity generally depends on the fund managers, what are the underlying assets they held, and if the underlying assets are liquid, these funds can be also more liquid. In general, they are less liquid than enhanced liquidity funds or money market funds, but it's very hard to generalize. They do come with it varying levels of liquidity, and the same thing can be said for the credit quality as well. Now, finally, for REITs, this is generally considered closer to a high-risk product, and they're income generating, but it does come with it higher risk. There's so many choices. What do we do? Let's put it together here. As you can tell in this diagram, all these different products, they comes with different level of risk. So ultimately, a choice of where to park and grow your cash is really a function of your risk tolerance and your personal profile. Now, cash management products, they are a lot more distinct in the sense that they're strictly defined as very low risk, and they tend to have very high quality assets. Within the cash management funds arena, fixed deposit generally has ultra low risk, but it comes with it a lockup period because investors do have to commit to putting the money with the bank for a certain amount of time before they get their earnings. However, the more liquid options and the also high quality options out there are the money market funds and the enhanced liquidity funds. Ultra short-term bond funds comes with its slightly higher risk than MMF and the ELF, but because of their amortized nature, and they are also less volatile in terms of day-to-day fluctuations. At StashAway, we believe investors should really take good care of deciding their risk level before deciding to invest in any investment-related products. It's absolutely critical to understand the different risk level of a cash management product from a bond fund or a real estate investment trust.